6 types of ETFs. An ETF is a type of investment fund that is traded on an exchange like a stock. It is a collection of securities, such as stocks, bonds, or commodities, that are bundled together into a single tradable asset. ETFs are designed to track the performance of an underlying index or asset, such as the S&P 500, gold, or oil. There are several types of ETFs, each with its unique characteristics and investment objectives, such as 1. Equity ETFs. These ETFs invest in stocks and aim to replicate the performance of an equity index, such as the S&P 500 or Nasdaq. 2. Bond ETFs. These ETFs invest in fixed income securities such as corporate bonds, government bonds, or municipal bonds. 3. Commodity ETFs. These ETFs invest in commodities such as gold, silver, oil, or agricultural products. 4. Currency ETFs. These ETFs invest in foreign currencies, allowing investors to gain exposure to a particular currency. 5. Leveraged ETFs. These ETFs use financial derivatives to magnify the returns of an underlying index or asset. 6. Inverse ETFs. These ETFs aim to provide the opposite return of an underlying index or asset. Pros and cons of ETFs. Pros. Diversification. ETFs offer investors the benefit of diversification by investing in a basket of securities rather than a single stock or bond. Low costs. ETFs typically have lower fees than traditional mutual funds, making them an affordable investment option. Transparency. ETFs are transparent in their holdings and performance, allowing investors to easily track their investments. Flexibility. ETFs can be traded throughout the day, providing investors with the flexibility to buy or sell at any time. Cons. Limited control. Investors have limited control over the individual securities within the ETF. Tracking error. Some ETFs may not track their underlying index or asset accurately, leading to tracking errors. Liquidity. Some ETFs may have lower trading volumes, leading to less liquidity and wider bid-ask spreads. Trading costs. While ETFs generally have low fees, investors may incur trading costs such as commissions and spreads. ETFs can be traded through a brokerage account, just like stocks. Investors can buy and sell ETFs on major stock exchanges such as the New York Stock Exchange, NYSE, or Nasdaq. Investors can also trade ETFs through online brokers or robo-advisors. It is important to research and compare the fees, trading platforms, and investment options offered by different brokers before choosing one. Conclusion: ETFs offer investors a convenient and cost-effective way to diversify their portfolios and gain exposure to various asset classes. However, as with any investment, it is important to understand the risks and potential drawbacks of ETFs before investing. By researching and selecting the appropriate ETFs based on their investment objectives and risk tolerance, investors can build a diversified portfolio and potentially achieve their financial goals. Visit us at www.investmenttees.com and use code BLOG to receive 25% on your next purchase. Thanks for watching.